Okay, in chapter 2, we focus on, again, learning how to record different types of business transaction. And we have this term known as debits and credits. Now, students often have their own definition of debits and credits. And I tell the students to dismiss your own definition and let's use the accounting definition for debits and credits. Now, it's pretty complicated, so pay close attention. You ready? All right. The word debit means left-hand side of the account. The word credit means right-hand side of the account. That's it. If you're asked to debit a transaction, it means record it on the left-hand side of the T account. If you're asked to credit a transaction, it means record it on the right-hand side of the T account. Do not complicate it, people. The word debit means left side, credit means right side. So what you have in front of you is what's called a T account. A T account is a form that can be used to record our different types of business transactions. So the account name goes across the top of the T account. The account name might be cash, account receivable, accounts payable, service revenue, etc. You list all your account names. Each account name has its own separate T account. Each account will have a debit side and a credit side. Now, there are certain accounts that will increase on the debit side, while other accounts increase on the credit side. It's contingent upon what is the account classification, meaning is the account an asset account, a liability account, an equity account, a revenue account, or an expense account. So again, depending upon whether it's an asset, a liability, equity account, revenue account, or an expense account, that will tell us what side of the account will make the account increase. In accounting, we have what's known as a double entry accounting system, which simply means that at least two accounts will be impacted by every business transaction. So if you debit one account, you must always credit a different account. And the total amount of those debits must always equal the total amount shown on the credit side. And we're going to practice how to use the debit and credit system to record our business transaction. Now, let's first look at the rules of debits and credit. Recall that accounting is a rule-based profession. These rules tell us what side of the account will make the account increase, what side of the account will make the account decrease. We're going to focus right now on the increase side. What side of the account will make the account increase? These are known as the rules of debits and credits. All right. For all of your asset accounts, cash, equipment, supplies, account receivable, inventory, vehicles, all asset accounts increase on the debit side. Once again, all asset accounts increase on the debit side. For assets, the debit side is known as their normal balance. The normal balance refers to the side of the account that will make the account increase. So if it is an asset account, the account will increase on the debit side because that is an accounting rule and accounting principle. If the account is a liability account, the accounts will increase on the credit side of the T account. For your liability accounts, the credit side is their normal balance because liability accounts increase on the credit side. And again, normal balance refers to the side of the account that will make the account increase. For your stockholders' equity accounts, it's comprised of common stock, retained earnings, and dividends. For stockholders' equity, the accounts increase on the credit side. The credit side is their increase side. The credit side is their normal balance side. When you think about common stock and retained earnings, these type of accounts will increase stockholders' equity. So it makes sense that they're going to increase on the same side because an increase in common stock will increase your stockholders' equity. An increase in retained earnings will increase your stockholders' equity. But think about dividends. What are dividends? Dividends are payments made to the stockholders of a business organization. Dividends refers to assets being taken away from the business organization. Therefore, an increase in dividends will decrease your total stockholders' equity. So dividends increase on the opposite side. Dividends increase on the debit side of the T account. The debit side is their normal balance side. Then we have revenues and expenses, which also impact stockholders' equity. When you think about revenue, think about the relationship. How does revenue impact stockholders' equity? Well, an increase in revenue will increase your stockholders' equity. Therefore, revenue accounts increase on the credit side the same as stockholders' equity. But expenses is money taken out of the business in order to earn revenue. Therefore, expenses decrease your stockholders' equity. Expenses will increase on the debit side. The debit side is their normal balance side. So now let's take a look at it and put it all together. Assets increase on the debit side. Expenses increase on the debit side. For your credit side increase, you have your liability accounts, your equity account, and your revenue accounts. They all increase on the credit side. Focus on what side of the account will make the account increase. If I know the account's increase side, they must decrease on the opposite side of the T account. Okay? Let's now put the rules all together. All right? Assets increase on the debit side of the T account, decrease on the credit side. Liabilities increase on the credit side, decrease on the debit side. Common stock and retained earnings both increase on the credit side, decrease on the debit side. Dividends increase on the debit side, decrease on the credit side. Revenue accounts increase on the credit side, decrease on the debit, and your expenses increase on the debit side, decrease on the credit. Now, know what you're saying. This slide may seem overwhelming, like it's too much information. My job is to simplify the information. So here we go. Focus again on what side of the account will make the account increase. If I know the account's increase side, they must decrease on the opposite side of the T account. So I've created two mnemonics, one known as DADE. The other is see clear. Yes, that's a word. As a professor, I can make up words, right? Okay. So let's go back to DADE. DADE shows the types of accounts that will always increase on the debit side. The A stands for assets. The second D, dividends. The E, expenses. These types of accounts will always increase on the debit side. See clear shows the types of accounts that will always increase on the credit side. The second C stands for common stock. The L, liabilities. we have two R's, retained earnings and revenue. So again, focus on what side of the account will make the account increase. If I know the account increase side, they must decrease on the opposite side of the TA account. Okay? Study these rules. We're going to come back at our next video presentation and begin to apply these rules in recording our business transactions.